Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. Now, looking at this morning's stack, CNBC, Bloomberg, Reuters, Yahoo Finance, it's painting a really almost contradictory picture. We're seeing booming markets, setting records actually, but then buried in these reports are these deep kind of hidden risks, structural issues, policy fights, stuff that could, well, potentially unravel things. So our mission here on the deep dive is to try and cut through that noise, pull at maybe the 5 or 6 key things you really need to grasp about the financial story this week.
Yeah, it's the contradictions that jump out immediately, isn't it? You've got Asia hitting these new highs, this real optimism, but then you drill down into, say, China or even France, and you find some pretty serious internal weaknesses. The whole global upswing feels a bit like it's floating, threatened by these sudden policy shifts or regulatory crackdowns. That divergence, I think that's the key thing to track.
Okay, let's start unpacking that. Beginning with the market highs then. The week definitely kicked off strong. Asia-Pacific reports, for instance, Japan's Nikkei 225 closed at a fresh record, 49,185.5. Partly helped by that coalition deal news, apparently. Hong Kong's Hang Seng Index was also way up, over 2.5%.
And Europe, too, surprisingly resilient. That's a key takeaway from the sources. They seem to be just shrugging off those credit worries from the U.S. last week. Broad gains across European markets. Even banks, the stocks, Europe 600 Banks Index moved into the green. But look where the real action was. Defense stocks. Rank, Rheinmetall, they saw pretty big jumps after those latest U.S.-Ukraine talks.
So buoyancy all around, it seems, until we zoom in on China. Now, on the surface, the official numbers look okay. Q3 GDP up 4.8% year on year. Industrial production actually quite strong, soaring 6.5% in September. That puts their full year goal around 5%, within reach.
But, and this is a big but, that's where the really worrying structural weakness is hiding, that strong factory output. It's masking real problems in domestic confidence. Because, okay, headline growth is fine, but look at the investment data. Bloomberg flagged this. Fixed asset investment actually shrank 0.5% in the first 9 months. I mean, outside of that initial COVID shock in 2020, that's the first year-to-date drop we've seen.
And one economist, Ziwei Zhang, called that drop rare and alarming. Why is that specific figure, the investment contraction, so critical?
No. Think about it. Investment is China's engine for future growth, right? It's separate from the ups and downs of exports. This contraction basically says Beijing is having trouble convincing its own companies to put capital to work inside China. And property investment, which is massive, that slid nearly 14% year to date. Relying just on exports when internal investment is drying up, that's not sustainable long term.
And then there's this deflationary pressure thing. It can be kind of hard to wrap your head around. The sources point out, real GDP grew 4.8%, but nominal GDP growth, that's before adjusting for prices, slowed to 3.7%.
Right. So that GDP deflator declining for the 10th straight quarter. Put simply, it means the size of China's economic pie might be growing a bit, but the actual cash value of each slice is shrinking. Prices are falling broadly, and that makes it incredibly tough for businesses to pay off debts, keep profit margins up, or, feel confident enough to invest more. It's a cycle.
Yeah, a kind of homegrown paralysis, it seems. But looking west again, China isn't alone in facing this mix of political instability hitting the fiscal side. France is now right in the spotlight. S&P Global Ratings just downgraded their sovereign credit score.
That's right. And with Fitch cutting them last month, France has now lost that sort of coveted AA rating from 2 out of the 3 big agencies. And this isn't just symbolic. For you, the investor, the real risk here is that some big institutional funds, pension funds maybe, have rules, mandates. They might be forced to sell French debt if it falls below that AA threshold from a majority of raters. So you could get forced selling triggered purely by political deadlock over budgets and reforms.
Okay, let's switch gears a bit. Geopolitics and trade. We're actually seeing a slightly softer tone from the U.S. on China trade. That helped U.S. stock futures this morning. Yahoo Finance noted President Trump suggested his threatened tariff levels on China are, quote, not sustainable. Maybe signaling tensions could ease.
And Treasury Secretary Scott Bessent basically confirmed that. Said relations have de-escalated before these key meetings with China's Vice Premier He Lifeng. Now, this potential thaw is interesting because it's happening right when the scramble for critical resources is heating up, especially after China's recent rare earth export limits.
Which brings us neatly to Australia. Bloomberg reports they're making a pitch. Prime Minister Albanese is basically offering up Australia's resources to the administration as a fix for that supply chain vulnerability.
Yeah, it's a pretty direct offer. They're saying, look, we can help fill 30 to 40 of the U.S.'s critical mineral gaps, especially processed rare earths. But It needs joint investment from both sides. It's not a freebie. And there's precedent here, right? Japan put serious money into Lynas Rare Earths back in 2011, and again just last year, precisely to lock down supply away from China.
Interesting. Meanwhile, though, the administration is also floating another pretty aggressive tariff threat.
Yeah.
This one aimed at allies. Get this. A renewed threat of a 100% tariff on movies made outside the U.S.
100%. And that's a huge potential problem for the UK, as CNBC laid out. Their film industry leans heavily on American partnerships. Those partnerships accounted for something like 65% of all UK film production spending last year. It's just fascinating, isn't it? We usually think tariffs, we think steel, chips, but hitting culture, hitting films, it just shows how far this kind of policy risk can reach into really unexpected parts of the economy.
That's actually a perfect transition, because we've got this market floating high, but facing policy risks everywhere. France, China, maybe the UK film industry now. So let's look at AI, the absolute definition of market optimism right now, but arguably wrestling with the most intense policy risk of all.
Oh, absolutely. The tension around regulation is just ratcheting up, even as these companies like Anthropic, valued at $183 billion, try to catch up to OpenAI at, $500 billion? And the fight is spilling out into the open now.
Right. Tell us about this clash with David Sachs, the VC guy. He's been pretty vocal criticizing Anthropic.
Yeah, Sachs basically accused Anthropic of regulatory capture based on fear-mongering. His argument is that Anthropic is pushing for really strict safety rules, like backing California's SB 53 on transparency, not just for safety's sake, but maybe also to create barriers, to make it harder for smaller startups to compete by locking in rules that favor the incumbents. He frames it as supporting the left's vision of AI regulation.
So you've got this clear split. Anthropic emphasizing safety guardrails, regulation. OpenAI, which is actually a White House partner on that Stargate project, lobbying for, fewer rules. The whole direction of the industry seems to hang on which approach ultimately wins out politically.
And then there's the impact on jobs. We're seeing this trend, reported by CNBC, where big companies are starting to explicitly blame AI for job cuts. Lufthansa cutting 4,000 jobs by 2030, Salesforce cutting thousands in support roles, both pointing fingers at AI efficiency gains.
Wow, those are significant numbers. But if CEOs are actually saying, we're cutting 4,000 jobs because of AI, does it almost matter more what people perceive than the underlying data? I mean, is it really scapegoating if it works as an excuse?
That's exactly the debate. Critics like Fabian Stephanie at Oxford, they argue AI is just a good excuse, a convenient way to explain layoffs that are really about correcting pandemic overhiring, market clearance, or just a general economic slowdown. And if you look at the actual studies from Yale, from the New York Fed, the disruption so far seems minimal.
Can you give us that data comparison again?
Sure. The New York Fed study found only 1%, just 1% of service firms said AI was the reason they laid people off in the last 6 months. But get this, 35% of those same firms said they used AI to retrain employees. So the narrative of mass job loss seems way ahead of the current reality on the ground.
Okay, one last piece on AI before we move on. Inside the ecosystem itself, NVIDIA, they're facing a threat from their own biggest customers, right? According to Yahoo Finance. Google, Amazon, Microsoft. They're all designing their own custom chips now, things like TPUs, Trainium, because they're cheaper and optimized for their specific needs.
Exactly. Google's been doing it for a decade with TPUs. Amazon's Trainium 2 is apparently well along. Anthropic is even using it. Microsoft's a bit behind with their Maya chip from last year. But analysts think these custom chips could grab maybe 45% of the AI chip market by 2028. It's all about avoiding vendor lock-in with NVIDIA, getting chips perfectly tuned for their software, potentially squeezing NVIDIA's margins down the line.
All right, let's bring this all back home to the U.S. consumer then. Economist Mark Zandi, he flagged what he sees as the #1 worry right now. He told Yahoo Finance, it's the stock market boom itself. That huge run-up, maybe $9 trillion in equity gains recently, that's what's fueling spending by high-income households. And he sees valuations as high, bordering on frothy. His point is, if that market turns, that spending could just evaporate quickly.
And that risk feeds right into what retailers are already seeing on the ground, this bifurcation of the consumer. The gap between high-income and low-income household behavior, it's apparently the widest it's been since early 2020.
So the wealthy are still spending, keeping luxury goods, travel looking strong, but lower-income families are really feeling the pinch. They're apparently visiting like 5 or 6 different stores each shopping trip just to find bargains. which of course is great news for the Walmarts and Costcos of the world. Interestingly, even among households earning over $200,000 a year, about a quarter are showing this new, more value-conscious behavior.
Habits are definitely shifting.
Okay, before we wrap, just a couple of quick positive updates for borrowers. The Trump administration has agreed to push through more student loan forgiveness. They're resuming processing for folks in the income contingent repayment and pay-as-you-earn plans. According to CNBC, that affects over 2.5 million borrowers. So some relief there. And a little tech bright spot from Reuters, early sales figures for the iPhone 17 series look strong, outselling the previous model by about 14% in China and the US so far. Apparently, the base model 17 is hitting a sweet spot, big feature upgrades, better chip, display, but at the same price as last year's.
Always interesting to see what resonates with consumers.
So putting it all together for you this week, what do we got? Incredible market highs, especially out of Asia and Europe. But that optimism feels fragile when you look at the internal strains in China, the fiscal pressures in France. And then you have the AI sector, huge valuations, huge excitement, but right in the middle of this really bitter political and regulatory crossfire.
Which leads to, I think, the key question for you to mull over. We talked about Mark Zandi's concern, right? That the U.S. stock market itself might be frothy, and it's the main thing propping up high-end spending. Now, try connecting that financial fragility directly to those policy risks we discussed, like the president floating a 100% movie tariff out of the blue, or the intense political attacks on AI companies like Anthropic over regulation. Policy risk feels like the biggest external threat right now. It injects this sudden, unpredictable uncertainty, and in a market that might already be overvalued. That kind of shock could easily destabilize things, turning Zandi's financial worry into a much wider crisis of confidence. Think about how quickly that could shift.
That intersection of finance and volatile policy.
Uh-huh.
Yeah, that definitely feels like the space to watch very closely this week. We'll see you all tomorrow morning with new headlines from major financial magazines.